I made this post on Twitter about Adobe stock on why I believe Adobe is not as undervalued as a lot of people believe. And I'm just not personally buying it. A lot of haters commented on it, a lot of people liked it, so it got a lot of attention. I'm sure a lot of people saved it so they can go back and tell me, you see, you marked the bottom and it was a contra indicator. And this is what people tend to do. Even though it takes 5 years from now, they will come back to this post and say, that I was wrong and they were right. And I'm fine, I don't really care. But I decided to do a video on Adobe to tell you why I am not buying this dip. The stock is down a lot year to date. It's down 23%. A lot of people are buying the dip. They see it as a 20% discount. For me, I see it as maybe the stock is 23% less overvalued than it was. And the stock did not do too bad on earnings. Latest earnings were amazing. They did grow 11% for a mature company. Things have improved. Earnings per share have improved. And things are getting better in general. Yet the stock is down so much. And a lot of people don't really know why. But I'm going to tell you why in the video, why I don't own it, and just my thesis on Adobe in general. Now, before I get started, I just want to say that I used to own Adobe stock. I bought the stock when it was trading a little bit cheaper before. Then I sold it a little bit too early, but I made some money on it. But I used to own Adobe. I recognize that Adobe is an amazing company, high quality company, amazing subscription-based business model, like 92 or 93% subscription. They have a monopoly with a lot of the Adobe products they have, the PDF products they have. So they have a pretty good competitive advantage in a lot of products. And my case is not much about AI replacing them. Maybe it could. I don't really understand this deep enough. Maybe AI could replace Adobe things that edit pictures and other stuff. But that's not what I'm focused on. My main concern with Adobe is not the business. The business is amazing and it's going to continue doing well. But my main concern is mainly around the valuation. Now, if you look at the valuation, Adobe is trading at 24 times earnings. You will look at that. You will say, oh, 24 times earnings for Adobe. It's growing earning revenues around 10%. It has a high return on capital, 92% subscription-based revenue, 38% net income margin. This is dirt cheap for this company, Adobe, at 24 times earnings. But even with those metrics, 30 times earnings was dirt cheap and 29 times. Yet the multiple continued to contract and the stock continued to go down. And this is because Adobe is not trading at 24 times earnings. Adobe is trading at 37 times earnings. Because if you look at the huge difference between GAAP and non-GAAP, non-GAAP is 18. GAAP is 11.88. This is a huge difference. A lot of companies did that stuff. PayPal fixed it. But you have to look at GAAP numbers whenever you have a company that has a lot of stock-based compensation. But for GAAP numbers, again, this is around 439. Now the stock is sitting at 444. This is around 37 times earnings for the stock. And you look at the stock-based compensation. It's been skyrocketing for Adobe every single year. Stock-based compensation for this stock is very, very bad. And you just cannot use normalized earnings. You have to use GAAP earnings to get the real earnings potential of the company. And on GAAP earnings, it's not trading at 24 times, it's trading at 37 times. So before that, it was trading like at 40 or 42 times, which explains the decline that it had. Adobe was priced to perfection. And in my opinion, it's still somewhat richly valued. And whenever you have a stock that's priced to perfection, if something doesn't come up, something doesn't go right, the stock will correct to the downside. And this is what happens with the market. But Adobe is not as cheap as you believe. A lot of people mention the free cash flow yield. This is another one. It's not good to use the free cash flow yield because the free cash flow is 6.9 billion. Out of the 6.19 billion, 1.7 billion is stock-based compensation. Stock-based compensation gets added to the free cash flow. So the total free cash flow for this company is like $5 billion. So you're getting $5 billion of free cash flow for a company that's trading at $200 billion market cap. It's really bad. And it's only growing revenues 10%. It's not like this is a high revenue growth company. It used to grow revenues rapidly. They used to grow 23, 24%. So a lot of people are looking at that stuff. They say, oh, it's trading below the mean. The mean was 34, now trading at 24. That means Adobe is undervalued. But Adobe used to grow around 24%. Now it's barely growing 10%. So this also changes the valuation metrics for Adobe because it's not growing as fast as it used to before. It's more profitable, which is a good thing for the company. But in terms of revenue growth for the future, it's only growing at 10%, and it might grow less than 10% if more competition and more pressures comes in the industry. But we're having 10%. And the free cash flow yield is not the best metric to use. Normalized earnings is not the best metric to use. On GAAP earnings, it's trading at 37 times earnings, which explains the decline. Now, the company is buying back stock and shares outstanding have been coming down. So it's not really affecting shares outstanding for stock-based compensation. This is not my problem. My problem is mainly with the valuation. But if we look at the valuation of Adobe, before I get into my fair value number, we look at the valuations. We determined that Adobe is growing revenues 10% and is trading at 37 times earnings. Okay. Now the question is, would you rather buy Adobe at 37 times, growing 10%, or would you rather buy a high quality company like Microsoft at 32 times earnings, not at 37, at 32 times earnings, growing 15%? And this is 32 times earnings GAAP, because GAAP and non-GAAP is the same thing with Microsoft. There's not a huge difference with stock-based compensation. So the question is, would you rather buy Adobe at 37 times growing 10%, or an amazing company, high-quality company, massive moat, massive growth in the AI stuff and everything, like Microsoft at 32 times growing 15%? To me, I would much rather buy Microsoft than Adobe. Now, I believe both of them are somewhat richly valued, but the main argument I got onto my tweets was that if you compare it to big tech, big tech, then all of them are overvalued. Maybe it is true, but on a relative basis, to me, Adobe still looks a little bit overpriced. But if I look at some basic numbers, this is their revenues for 2023, and for 2024 and beyond, I put in 10% revenue growth. This is what is expected. This is what they've been doing. I think it's fair. 38% net income margins is pretty good. I'm using non-GAAP stuff here to keep it simple. Non-GAAP PE is 24 times. Huge difference from 24 to 37. By using 24 times, okay? Now let's assume you guys are right, and Adobe's multiple is just too low, and it gets a multiple expansion back to 30 times. It's possible, although I don't think it would happen, but it's very, very possible. Now, if Adobe goes back to 30 times, okay, and we use the 30 PE ratio, and we use a 1% yield, which means if they buy back 1% of the market cap, in total, even though we're using 10% revenue growth, even though we're using, from 24 to 30 times the multiple expansion, my upside is 84%, or 13.3% CAGR over the next 5 years. I personally look for doubles, so 15% a year for the next 5 years, around doubles every 5 years. In this case, if I want to get a double, I would have to buy Adobe at 411. Now Adobe is at 441. And in my opinion, this is the best case scenario for Adobe. Now, the worst case scenario is maybe the multiple stays at 24 times. It's very possible. If this multiple stays at 24 times, which is around 37 times GAAP earnings, in this case, the upside is 48%, or 8.4% CAGR, like the same return as the S&P 500. And in this case, I would have to buy Adobe at $331 for me to get anywhere close to a double over the next 5 years with a stock like Adobe. So the way I'm looking at Adobe, to me, the stock is getting better valued. Its valuation is improving. It could be a buy if everything goes right. So if everything goes right, Adobe could be some kind of a double or return 85% over the next 5 years. But if that doesn't happen, the return could be only 48 to 50%. So for me, if I want to buy Adobe, it has to be close to $300 per share. 300, 320, 330. I think Adobe would be a good starting position, dollar cost average down. But at this price, I'm just not seeing a margin of safety with Adobe, and I'm seeing better relative opportunities elsewhere. So for me, again, I know people are going to come back to this video, come back to this post, try to troll me. Maybe if they did something good on earning, or the stock goes up, or it bottoms and goes to 35 times earning. But I'm just arguing the valuation. For me, Adobe right now, relative to other opportunities, doesn't make sense. If it gets to 300, 320, 330, in the low $300 range, I think Adobe would be a good buying opportunity. But right now, there's way better stocks, way better opportunities than Adobe at this price. And this is just my opinion on Adobe, not financial advice. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.